On today's Hot Sheet, I have some interesting breaking news in commercial real estate. I'm talking inventory, housing inventory, of course, the inventory shift from 2019 to 2013, October jobs report. Today is Monday, November 6, 2023. I am Byron Lazine. I'm sitting in a WeWork, and the Hot Sheet starts now. Good morning on the Hot Sheet. Let me know in the live chat which market you are tuning in from. I'm tuning in today from Austin, Texas. I'm here for Zillow Unlock. Zillow invites top, 1% of their partners across the country each and every single year. It's my first time coming to Zillow Unlock since 2019. So I'm looking forward to sharing later in the week with some of the things discussed here in Austin. I'm sitting in a WeWork in Austin for couple of reasons. Reason number one, the internet at the hotel wasn't good. So I made an audible. Reason number two is WeWork came to top of my attention this morning as I was reading. You may have saw the same article that I did. Wall Street Journal reports today that the WeWork stock is halted. This co-working giant had been preparing for bankruptcy filing. So you might have heard on Friday, WeWork preparing for bankruptcy filing. The New York-based desk leasing giant has lost more than $16 billion since its founding in 2010. It's been burning through its remaining cash amid an unforgiving office market. So I'm in the phone booth here. I wanted to see what the vibe was in a WeWork in a big city vibe, hip city, right? WeWorks are supposed to be hip, like Austin, Texas. And I will say there's a lot of people coming in and out of this WeWork, okay? I've got some people taking a tour right next to me. So business as usual here at the WeWork. But this is going to be a big ripple effect through commercial real estate, commercial office building in particular. We know that there's $3 trillion coming due. And as WeWork files bankruptcy to kind of wash away its $16 billion in losses, they're going to go back to many of these or all of these leaseholders, these buildings where they have these beautiful spaces. And I mean, this is a beautiful space, this one here on Congress Street in Austin that I'm sitting in. And they're going to try to renegotiate, or the bad locations that maybe don't have as much activity as this one, they may go and say, hey, we don't want the lease at all. So that could be one, but yeah, we don't want the lease at all. We want to renegotiate the lease in some form or another, or maybe maybe some premier locations where they are profitable, they may keep that lease. Because just because they're going through bankruptcy doesn't mean they're going to close all of these up. The likely scenario with the WeWork brand and the foot space that they have is that somebody will come in and buy WeWork. There'll be some type of revitalization of WeWork through this bankruptcy, but they've halted the stock. I hope that you are not a stock holder. If you are, that is unfortunate for you. And we'll see what plays out here. But I want to come in and check out the vibe. And that's the vibe here. Let's get the vibe on the housing inventory update as we do each and every single week here on Monday. And let's go over to the Altos research report here for this Monday. And Bobby, if you could go, because I've got Bobby on the other end helping me out. If you could go right to the first slide there. There you go. Weekly inventory rose from 562,000 to 566,000. This is interesting because the same week last year is when we saw inventory starting to decline for the seasonal winter decline that we typically see. So last year we saw a decline of 578,000 to 574,000 on weekly inventory. This year, same week, we go up 4,000. Last year, we lose 4,000 in the same week. Now, we're getting closer, especially with last week, we're getting closer to being at inventory neutral for the same point of last year. We're only 8,000 away. If we were to gain another 4,000 next week, for example, we would basically be at inventory neutral. As this point last year, we started to see the inventory decline. Now, history tells us that as we get closer to Thanksgiving, we will see an inventory decline. Let's see if 2023 quarter four bucks that trend. We did see, obviously, interest rates help us out over the last week. So maybe we'll get into more of a normal seasonal decline, and we'll just kind of monitor what happens there. The inventory peak for this year is right now. It is the 566,882 as we sit here today. Active listings for this week in 2015 were at 1.140 million. You're looking at now this slide, and all of our slides are available for BAMX members in our daily download. You can become a BAMX member by using code HOT to get 10% off of BAMX. This slide here is new listings. So we are even par with where we were last year, 51,144, same week last year for new listing data. This year, a little bit higher, but really ultimately flat at 51,986. You can see the dark red line being 2023 is and has been really just dead heap even with 2022 over the last couple of months. Certainly earlier in the year, we had a huge gap. This is the year for the lowest new listing inventory on record. And so we'll see if this continues to fall, the steep decline that we typically do see as we get from Thanksgiving until the end of the year holidays. Now we're also tracking these price drops. Will you own the WeWork by the end of the hot sheet? I don't think so. I think there's a lot of people that own that stock out there, obviously, and they've lost 16 billion. So somebody wants WeWork. I don't think it's me. I'm sitting literally in a phone booth right now, but I had to check out the vibe. This is going to be a huge commercial real estate story, and it's also going to be a huge regional banking story. Remember earlier in the year we were talking about regional banking all the time? Well, regional banks haven't written off the losses that they're about to incur from office buildings. This could be the start of that. When they have to adjust their balance sheets, okay, your building's not worth 80 million or whatever it says on your balance sheet anymore. When the building owner has to go refinance that commercial asset, which $3 trillion is coming due in refinances, they're going to say, hey, the interest rates are too high, vacancies are up, demand is down, this is what I can pay. And so when they go back to the bank and say, I can only pay you for a $40 million building and the building is worth 80, you're going to see a lot of bank balance sheets highly impacted. And will this have a ripple effect like we saw at the beginning of last year? All signs right now point towards economy being very strong. Maybe we're going to have some type of rebound in the stock market, right? Last week was a really good week for the economy, a great week for interest rates, a great week for the 10-year. But we still haven't tackled the sleeping giant, which is the commercial office buildings. Okay. Let's take a look now at the price drop update for the week. And we reported that not only last week, not only is Fannie Mae saying we're over last year on price drops, and Bobby, if you could pull up the Altos research slide there on price drops, not only is Fannie Mae's reporting higher price drops, but Redfin was also reporting an increase in price drops. And yet, what we actually see, nope, it's actually just all right, so Bobby doesn't have it. Go ahead. That's all right, Bobby. Apparently, I'm looking at your slides there. Apparently, you don't have it. It was on the Altos report. We'll have it in daily download for anybody who wants to grab it there from BAMX. So this week, this year, we've had 39% single family listings with a price drop. Same week last year, 43%. So Altos research is not in agreement with Redfin that were over this time frame last year. I like Altos Research. I think they do a little bit more of a diligent job there, so I'm going to go with that. But it's still rising. We were just at 38% the week prior, now at 39%. So you are seeing price drops on the rise. Let me know in your market if you're seeing the same thing. Okay, let's go to housing market inventory from 2019 to 2023. It's always good to take a look backwards and build in some context of where we're at right now. Housing market inventory so far is below pre-pandemic levels. October's big jump is still just a drop in the bucket. I mean, we're still under last year, which was historically low. So we're just, and you can look at the first chart here, active U.S. housing inventory for sale. This is from Resi Club. This is using the Realtor.com data. So comparing, obviously, Realtor.com versus what we just saw with Altos Research here. And you can see that while we're getting a little bit of a pop, we've got more inventory, active U.S. housing inventory than we did in 2021. We're dead even with 2020, and we're still below last year of 2022. So year over year, Altos Research and Realtor.com in agreement here that we're below 2022. But maybe just one more week. If we get one more week of an increase in inventory before we start the seasonal decline, maybe we could get even for one moment in time here this year. Obviously, significantly below the active inventory for 2017, 18, and 19, when we were all up over $1 million on those years there. So you can go ahead to the next slide there, Bobby, so you pull it up. Inventory shift between 2019 and October 2023. Everybody's in the red. Everybody's got less inventory. There's like a couple of pockets here. Maybe I'm sitting in one of those here in Austin, Texas, where you've got a little bit of inventory increase, even off of pre-pandemic levels. But the majority of the country, the West showing deep inventory drops, the Northeast showing the same. You have pockets in Texas, you have pockets in Florida, and then a couple out there in that Midwest part of the state, of the country rather, where you've seen some inventory increase. So here's something directly from Resi Club, just specifically about the city that I'm sitting in, talking about Austin. Continue to watch Austin, but there are other places now similar to Austin where you see inventory up. Baton Rouge would be one of them, up 25.4%. San Antonio up 20.6% year over year. Memphis is up 30.3%, and New Orleans is up 26.1% on inventory. So it's not just Austin where I'm physically sitting right now. There are many other locations here across the country where you're seeing inventory on the rise year over year. What we really want to watch for is how is November going to react as we get closer to Thanksgiving holiday. Are we going to see that seasonal decline in inventory that we typically see with already historical low levels of inventory and new listings being the lowest year on record? What will that do to transaction count, especially if the 30-year fixed holds firm where it's been at 7.5 and higher, or what we're off of our 8%, which is good, which brought some relief. But we can expect to see really tight transaction volume all of November, all of December, and most of January, where last year we saw activity and showings really take off in January. Remember, last January was 6% 30-year fixed. Are we going to get there in the next 60 days? I don't see signs that we are, but maybe if we compound a couple more weeks like we had last week, where the market really is favorable for the climate of what's going on, then maybe we could see some momentum in that direction. Let's go through the rest of the Resi Club slides on the inventory shift here. You have those, Bobby. Month over month shift, U.S. homes for sale on Realtor.com. Active listings on the rise. So this is a good sign. We need to continue to see active listings trending up. We're just again battling a tough time seasonally on that. And this is just year over year inventory shift. You see a lot of the Sun Belt, the South, Florida, Texas. Again, we mentioned Baton Rouge, where you're really seeing an inventory shift in the upward trajectory year over year. The Northeast is still getting pummeled. California and the West is still getting pummeled on inventory declines just year over year. Moving forward here, onto the next slide there, Bobby. Here's the new listing data that we just covered on Altos Research. Here showing you more years with Realtor.com numbers. This is the lowest level of new listings on record. I mean, this data that we're looking at here goes all the way back to 2017. And most years outside of last year, when interest rates went through the roof, right? That's when you saw the steep decline last year. Most years are well above this time, even for this time of year on new listings. So we're just up against, a historic abnormality when it comes to people raising their hand to sell their homes. All right. Let's go next here, Bobby. We've got the jobs. So I think I did mention jobs a little bit, maybe quickly on Friday. That was, I know we mentioned it on Knowledge Brokers podcast. It was one of the momentum pieces for last week that continued to really support a positive market and dropping that 10-year, which is what we all want to see. So the October jobs market that was released on Friday morning has indicated a cooling labor market. A lot of times you hear that and you might think, well, how is that good for the economy? It's great for the fight against inflation. So October jobs supported a cooling labor market, many sectors experiencing job growth that resulted in relatively modest addition of 150,000 jobs to the economy. Just in September or August, I think it was, we had near 300,000 jobs. So this is well off of that. This also was below expectations. So anytime it comes in below expectations, that's good for the fight against inflation. Healthcare and social assistance were where more of the jobs were added, 77,000 jobs, with the private education. If private education was actually included in that number, there would have been 89,000 jobs just in that category alone. Government employment increased by 51,000 jobs in October, making it the second strongest category. I thought we were up against, a lot of budget talk and budget restraints, and we don't have money in this. We added 51,000 jobs in October. It's now returned to its pre-pandemic level. Woof, good thing. As reported by U.S. Bureau of Labor Statistics, government is hiring. Okay. Some sectors experience minimal job growth, which is interesting, right? Because the government knows that we have an issue with jobs getting out of control and the fight against inflation, right? Which is Jerome Powell's mandate from the government. It's like, hey, you need to get inflation down to 2% while also maintaining a good, healthy unemployment level. Well, if the government is one of the biggest, hirers out there for jobs, that kind of goes against that goal a little bit. 51,000 in a month is a significant pop. I mean, you can put construction and professional business services together combined and didn't match government hiring there. Leisure and hospitality, you can see at 19,000. Wholesale trade at 9.4. Some of the industries that lost had negative job growth: financial activities, information, transportation, and warehousing. Look at manufacturing, down 35,000. And that was the weakest in October. it's attributed mostly to the strikes that you see. So that could be also something that is impacting this number. The Bureau of Labor Statistics report does suggest that the situation may improve in November. So that's like signaling, hey, there might be some agreements here. Autos Worker Union, Detroit automakers could be coming back and seeing some of those jobs come back. All right. As I sit here in this WeWork, I will give another final update here because I don't think I'll be back here tomorrow. Because when I had to like sign in, I had to download the app and all this stuff. The app didn't work, so I'm technically here pro bono right now. I have to go square up on my WeWork. The app crashed 3 times. I didn't want to say, hey, I don't know, I know the stock is halted. I don't know if the app is halted. But I will say a lot of people in here. So, business as usual on WeWork while the stock is being halted on the markets. $16 billion they lost. That's that SoftBank group that, was just pouring money into everything. Overall, the markets are up today, Dow, S&P, and NASDAQ. Let's take a look at where we're sitting here, Bobby, if we can, on the 10-year. As well as we'll bounce over to the 30-year fix where it ended the week last week. So we're at 4.633. So we've come down off of the 5. We've come down off of the 4.9. Don't mind this range based off of where we've been the month prior to last week. Let's take a quick look at the 30-year fix where we ended last week, which there we go here. We're at 7 point. Look at that number for Friday. If you could zoom in there, Bobby, it's such a beautiful number. We all can rejoice there. 7.38 under 7.5 for the daily survey last week. I mean, if we can get closer to 7 going into the end of the year and the new year, I think we'd all take that with what we've seen the last few months. It wouldn't be the 6% that we headed into January this year with, but it'd certainly be more affordable for more. If we can get inventory coming on into that spring market sooner next year, those would be 2 dynamics that would be really good for buyers who are struggling with affordability in this market. We're going to continue to monitor it each and every single day here on the hot sheet. Really appreciate you guys being with us. If you want to get the most out of what we're doing, definitely use the link down below, code HOT to get 10% off of BAMX. BAMX prices do go up December 1st. So right now, this throughout November is going to be the lowest opportunity to get into BAMX. You get access to all of our content, our daily downloads, all of our extra content and courses, that is, all of our daily downloads from the hot sheet, as well as our live streams. We did 3 of them last week. So last week's such a wild week. So use code HOT to get 10% off of that. Appreciate you guys being with me. Hit subscribe and ring that bell if you haven't done that already. We'll see you guys here tomorrow on the hot sheet. Until then, toodaloo.